Hey, what's up guys? In this video, we're going to talk about how to structure your side gig business. All right, let's get started. All right, so here's the deal. If you're considering starting a side gig, or maybe you already have one on the side that you've been generating some money from, a question that comes up all the time is, how should I structure that, or should I even structure it at all? Well, when it comes to a side gig business, what you really need to look at is how much income you're generating and what type of business it is, meaning what type of liability are you bringing on yourself and potentially your family from running that side gig business. So those are two of the main concerns that we have whenever we're working with someone who is collecting money from a side gig business or running some type of activity. And that's really going to determine whether or not you should create a business entity. Now, if you choose to set up a business entity, then the next question is going to be what type of entity is that going to be and how is it going to be taxed? I'll show you what I'm talking about. If I'm running a side gig business and that business right now has low liability with it, so what might that be? Well, low liability business could easily be something that you're running online. Maybe you're selling stuff on an Amazon store and you're just the middleman there. So there's not a liability with that type of business. If you have low liability and relatively low income starting out, so if you're under, say, $10,000 a year from that side gig business, then the question of whether or not you need a business entity would probably be no. And why do I say that? Because it's unlikely you're going to be sued from this side gig business with the type of activity you're running. So you don't need an entity to protect yourself. And the other thing is that the income, since it's low, it's under 10K, it's not really going to behoove you to set up some type of structure that is going to provide you a way to control your income. Because your income that you generate from a side gig business is typically going to be active income because you're involved in the production of that income. And so there's employment taxes that have to be paid on that. And so when the income gets up at a certain level, we want to be able to reduce those employment taxes. But the problem is if you set up an entity to reduce your employment taxes from your side gig business, the tax savings needs to cover the cost of maintaining that entity and possibly filing the tax return that's going to be associated with that type of business. And so there's a very fine line there. So the next thing I would look at is, let's say you had a side gig business and you have medium to high liability, but again, we're sitting in that low income category. So you've got medium to high liability, but low income still. So what might you be considering there? Maybe you're doing something with Uber on the side or DoorDash, something like that, where you're driving around. So you could potentially run into someone and there's liability there. So in that situation, what I'm going to be looking to do is protect myself or put something around my structure. I mean, you can never get out of your personal negligence, but creating a business to protect against liability makes sense in certain situations. And so if you've got medium to high liability and low income, then the entity that I would consider setting up is going to be a limited liability company. I'd set up an LLC. And again, going back to that cost standpoint, you're using the LLC to cover the liability aspect, but because we've got low income right here, you don't want to treat that LLC as either a C-Corp or an S-Corp from a tax standpoint, because it just wouldn't pencil out when you look at the cost of filing that tax return. So the thing about an LLC, if it's just you and it's your only side gig, you're running the business. So if there's just one owner, we could set this up as a disregarded entity. And what does that mean? It means you're running it like you are up here as a sole proprietor, that you don't have any formal business structure. You're just out there generating a little extra side income. You would not have to file a tax return for this LLC when you set it up as disregarded. Now, that brings me to the final structure, in that if you have a high income here, so let's get out of this. Let's say instead of being low income, this business has high income and medium to high liability, or even if it was low liability. Really what I'm focused on now is the income that's being generated from the activity. So the income is going to be the driver. So if you have a side gig business and you're generating, say, $25,000 and above, then I would still consider setting up a limited liability company, but rather than treating it as a disregarded entity, now you're going to want to look at treating it as an S-corporation. You want to set it up as an S-corp. Now, the reason why we're going to set this up as an S-corporation is because we want to save ourselves on employment taxes. So an example of that might be as follows. Let's assume that I make $50,000 a year in my side gig business. Now that $50,000 a year, if I have a disregarded LLC or I'm doing it in my own name, all of this income is subject to income taxes. All right, you got to pay your normal income taxes on it, plus, and this is why you want to pay attention here, plus employment taxes. I'm just going to put EMP tax, employment taxes, and that's 15.4%. So on $50,000 in earnings, you have employment taxes plus income taxes. So this right here is the number that we're playing with. We want to be able to knock this number down, and that's where an S corporation is going to benefit you for your side gig when you've got this higher income here. So 15.4% of $50,000 is going to be roughly $7,500 in employment taxes. So by setting up as an S-Corp or an LLC taxed as an S-Corp, what we end up doing when in this situation is that if we make $50,000, we'll pay ourselves a salary of $25K. When you pay yourself a salary, you're going to be subject to this 15.4% on that income. So my employment taxes now, that employment tax portion, rather than having employment taxes on the full 100% that I generated, now it's only going to be taxed on that $25,000 that I took out here. So that would put my employment taxes at about $3,750. So what I did is I cut that tax in half. And so my remaining portion after I paid myself a salary that stays inside of this S-Corp that flows out to me, this $25,000 that comes down to me, that will not be subject to this tax. So I get an extra $3,750 in tax savings. So that's why I said you really have to look at it when you're doing this. It's a $3,750 tax savings here. And after you figure out you have to file a tax return for this entity, maybe you're going to hire someone to do that for you. Say that costs you $1,000. Now you put an extra $2,750 back in your pocket. So in this situation, I think it would make sense. And that's really driven, as I stated earlier, by your taxes. So if you have a side gig business and it's making you some decent money doing that side gig, you should probably look at establishing a limited liability company treated as an S corporation. Hey, if you want to learn more about setting up business entities and analyzing when it makes the most sense and maybe even using a C corporations, I'd like to invite you to our tax and asset protection workshop. I got a link to it in the show notes below. We hold it about every other week, and you come to that event, you're going to learn all about how to set up the right business structure for your business, talk about the various business forms, and more importantly, we're going to give you massive tax strategies that will help drive your taxes down to the lowest point as possible. I hope to see you there.